If you're someone who regularly donates to a local church, or if you donate to a charity or an organization that you care about, and at the same time you're donating in cash, today I want to share why giving in cash is one of the least tax-friendly ways to give. Of course, giving at the end of the day is for the purpose of helping the church or a charity that we care about. But I always say if there's a more efficient way to steward our wealth, that's something that we should probably look into. So today I'm specifically talking about a donor advised fund and ways that you can help pay more to your church or the charity that you care about and pay less in capital gains and less to the IRS in the process. So if that sounds like something that's interesting to you, today's topic is going to be that. So let's start simply by understanding the difference between an itemized and a standard deduction, because this is important if you are someone that regularly gifts to understand the difference between. So an itemized deduction is going to be similar to a receipt at a grocery store, right? And when you go to the grocery store and you buy all your items, they give you that 10-foot long receipt at the end of it, and it has a list of everything you bought. Think of your itemized deduction in a similar way, only this is the amount of deductions that you took for the year. So I donated to this church, I donated to this organization, I have a deduction based off of the interest on my loan, based on my house. I have a deduction for several other things, right? It's a long list that you have to add up. Your standard deduction is going to be different. It's just going to be a one-size-fits-all that the government allows you to take based off of how you file your taxes. So let me give you a simple example. If you are married in 2025, the government has a standard deduction of $30,000. If you're single, it's $15,000. It's half that. But put this in play, if you and your wife make $200,000 combined, at the end of the year, in the eyes of the IRS, you made $170,000, right? Because they allowed you to take that standard deduction. The difference is with the itemized deduction, if you make above or if you have more deductions than whatever your standard deduction maximum is, you're going to take the itemized deductions. I wish you could take both. You can only take one, so keep that in mind. But a lot of people that give don't understand that unless your itemized deductions equal more in excess of your standard deduction, it doesn't actually reduce your taxable income, right? You could give $29,999 and have no other deductions. And if that's all you have to bring to the table, you're still going to take the standard deduction. Let me throw this visual up on screen here briefly because this illustrates what I'm trying to say, maybe a little bit better. The first bar, of course, represents that $30,000 that a couple is able to take per year, and the two bars are the examples of the itemized deductions. The first bar, of course, does not hit that $30,000 threshold, and thus this person would take the standard deduction, whereas the second bar breaks through that $30,000 barrier, and of course they would take the itemized deductions. Now, why am I talking about all of this with you when we're just trying to talk about a donor advised fund? It's important to understand because any contribution that you make to your church or your charity is going to go into that itemized deduction bucket. Therefore, it's going to have to be more than your standard deduction to be able to withdraw from your income. So a donor advised fund helps with that because I'll kind of get to this in a moment. You can actually add multiple years worth of giving and kind of throw it into your donor advised fund at one time and take a large deduction in one given year. If you're not familiar with what a donor advised fund is, or a DAF in short, think of it similar to a charitable investment account. The reason I say that is the end goal of a donor advised fund is still to donate to the charity or the church that we care about, and at the same time we're allowed to invest those dollars. Only it's a different account. Any dollar, any asset that you put into a donor advised fund is irrevocable, meaning you can't get those dollars back, right? If you put $30,000 into a donor advised fund and a couple of days later you change your mind, well, that's going to be very difficult to actually get back. And the reason is you can take a present day tax deduction based off of the amount that you put into a donor advised fund. Now, it's going to depend on what type of asset and what your income is in terms of how much you can deduct. Let me throw that up on here on screen and maybe a helpful diagram too. But the main purpose of a donor advised fund is to be able to reduce your taxable income in a given year. I've sort of already mentioned some of the main benefits of a DAF. One is the present day tax deduction. Two is that you can invest the dollars after they've been put into the account. And three is you have more control, right? You can choose what years you want to make donations, right? You could make a donation this year, next year, and then 10 years from now and totally be fine from a tax and legal standpoint. Some more advanced strategies that come with the donor advised fund are one, if you have the ability to do what's known as bunching and add up several years worth of contributions or donations into one single year, what you'll be able to do is take a much larger deduction based off of that large contribution to your donor advised fund than you otherwise would have, right? So if I'm someone that regularly gives $20,000 to my church, and I say, hey, you know what, I'm going to somehow be able to sum up $60,000 in this year, put it into my donor advised fund along with my other deductions that I'm taking for the year, I have the ability to save on a lot more taxes than I otherwise would have. This is a term that we normally refer to as bunching, and that's just simply trying to bunch up a lot of the donations or deductions that you would have taken over several years just in one year, right? So this does take a lot of cash or a lot of assets up in front, so I do realize that. The second strategy that I want to mention here is donating an appreciated position. A good friend never lets another friend donate cash, and here's why. It's an after-tax asset, meaning that dollar has already been taxed, and then I turn around and give it to the charity. The government's had their fair share, the charity gets their piece, and I'm here left with nothing, right? And I already had to pay the tax. What you could have done is if you have a non-qualified account, such as a brokerage account, any account that's a non-retirement account, if you have real estate, if you have cryptocurrency, any appreciated position, you are technically allowed to put into this donor advised fund and then turn around and donate that to the charity. What you've done here is that you don't have to pay the tax on that gain, and then the charity doesn't have to pay taxes on that gain, and you got to take a present day deduction because of it. Maybe I'll give you a specific example here to further illustrate this. If Jim has $30,000 of Apple stock, but a long time ago he bought it at $5,000, he's got two options on his hands if he's planning on donating to a charity. Jim can sell that Apple stock, which would be on the $25,000 worth of earnings, or Jim could put that $30,000 of Apple stock into his donor advised fund, pay zero in taxes, and then turn around and donate $10,000 a year for the next 3 years to a charity of his choice. All in the meanwhile, Jim would have had that ability to take that present day deduction on the amount that he put into the donor advised fund. As I mentioned, same thing can be done with real estate, crypto. Rules do change based on where you have this donor advised fund opened up, but know that this is very flexible and very tax friendly if you do so in the right way. Maybe even further go on to that example here, just so we're fully aware of our tax options available to us. Let's say Jim donated that $30,000 position in Apple, and he turns around the next day and he's like, man, I kind of wish I had Apple. Jim still has other cash that he regularly has aside to donate to whatever charity. And because he did not donate the cash, he donated the Apple stock, he's actually allowed to take that cash and now buy Apple. What Jim has done here is he's now bought into Apple at a higher basis, meaning he has a higher standard or a higher starting point from where his new tax will start at. As you know, with a brokerage account, you're only taxed on your earnings. So there's really just a few examples that I want to give of some mistakes that folks make when they're giving with a donor advised fund. The first is not realizing that this is available to them, right? A lot of people don't know about a donor advised fund. They've been more common over the past few years just because of social media and channels like this, but a lot of people don't understand that. The second piece is not understanding the difference between the standard and the itemized deduction, right? Remember that if you don't give cash or if your itemized deductions don't equal more than your standard deduction, it doesn't actually reduce your taxable income. The third piece, and this may even go along well with a donor advised fund, is not being able to track all your deductions. Remember, anytime you make a donation, it's very important that you have proof that you made that donation, because if the IRS comes knocking on your door, or if you have to prove that you owned a specific asset that you donated into a donor advised fund, it's wise to have that documentation. The last example I'll give here is just not giving an appreciated position and instead giving cash, right? I would have a long conversation with your CPA or tax professional about if this fits you or not. We always recommend having a financial advisor or a trusted tax professional whenever we talk about tax strategies, but we have to remember that a good friend does not allow their other friend to give in cash. And the reason is it's an after-tax asset, and it's much more valuable from a tax standpoint, of course, to give an appreciated asset if you're already someone that's giving, and if, of course, you have assets that have appreciated a lot. That's just the most ideal and tax-friendly way to do so. So I hope today's video was helpful. I know maybe I sort of rambled a little bit. Donor advised funds can be fantastic accounts if you're already giving in large amounts or if you have appreciated positions. If you have any questions for me or for your financial advisor, I would definitely recommend asking those before you open up a donor advised fund. The same goes with the CPA, as I mentioned. But if you are someone that gives regularly, this is definitely something to consider. So I thank you guys so much for your viewership today, and I hope you have a good one.